Hello, I'm Nathan Kubik, and thank you for joining us for a discussion on alternative investments. This will be the first in a series of discussions on the alternative marketplace. For this first discussion, we will be focusing on income-producing alternatives and how they can fit into portfolios, as well as the benefits and risks that are inherent in these strategies. Alternative investments are generally utilized for three primary but potentially independent reasons. The first is to hedge a portfolio. As the name implies, these are generally used to reduce or hedge a perceived risk exposure. The second is to diversify a portfolio. By adding an uncorrelated asset to a portfolio, the intention here is to reduce overall volatility and shift the relationship between risk and return. The third is to enhance a portfolio. Enhancing a portfolio is often done through adding a correlated asset to a portfolio that has the potential to amplify returns, but generally does so with increased levels of risk. These categories can be independent of one another, but alternatives can have contributing factors for multiple categories. It is important to understand the nuances of each of these buckets and how the addition of an alternative might impact your overall portfolio and its risk-return relationships. While this first discussion is on income-producing alternatives, it is important to understand that this is but one part of the entire alternative marketplace. We will be going into some other alternatives in future discussions, and here we consider some of the most well-known alternative spaces. Private equity is equity ownership in privately held securities. In other words, companies that are not listed on the public stock market or exchanges. Private credit, which is direct lending to companies through channels not accessible through the public markets. This lending can be done to public or private companies, but where the secondary markets are less efficient than that of securities like bonds. Private real estate is the investment in properties through pools of investments, and like all of the aforementioned strategy, has a wide range of risk-reward profiles within that bucket. Hedge funds are the final bucket, and it's a term that's all too often used too freely when talking about alternatives. In truth, hedge funds are strategies that often utilize derivatives and leverage to enhance or constrain parts of the risk-return spectrum. There are many types of hedge funds, and this marketplace has changed dramatically over the years, with technology adding much efficiency to the markets, which has eroded many of the arbitrage opportunities. But today, we are focused on income-producing alternative strategies. The reason we are focused here more intently than others is due to the current interest rate environment that we are in. As we've been discussing, due to macroeconomic pressures and government intervention, interest rates are currently at very low levels. Looking at the blue line, we see that the yield of the US bond market is near the low of the last 50 years. Additionally, companies have recognized this and have extended their duration or maturity dates to lock in these long rates, which we can see in the gray line. Rates have moved up from their lows in August of last year, but we are still in a difficult period when it comes to yield and interest rate risk. In addition to the US federal government continuing to hold rates low through bond purchases, the rest of the world is doing the same, and there are still a number of countries whose interest rates are actually negative. Now, we are looking at sovereign debt here, but it is important to realize that all other bonds have yields that correlate and spread off of these curves, and that rates across the board are quite low. Here, we look at the market yields for the US 10-year Treasury, the municipal bond market as a whole, and the US corporate bond market as a whole. As you can see, interest rates for each of these asset classes has fallen dramatically, and this makes fixed income investing a difficult place to be right now. Within the public markets, there is simply no place to hide and still collect a good yield without taking on unwise risk. This is a time period that some investors have chosen to take on additional equity risk or default risk, which adds the potential of derailing their financial plan. This is especially concerning given the meaningful impacts to an overall portfolio from a risk-return standpoint. This is a time for patience when it comes to bonds, and what everyone should be focused on is interest rate risk. Remember that the current market value of bonds is based on a time value money equation of future coupon payments and the maturity or call date principal repayment. In this chart, we consider the impact of bond market values with just a change of 1% in interest rates. In other words, if interest rates rise by 1%, these bonds would devalue by the amount shown here. As you can see, chasing just a little bit more yield by moving to a longer maturity date has the risk of having a much more dramatic impact from a rise in interest rates. Now, holding an individual bond to maturity will result in the same overall interest rate you had locked in when it was purchased. But there is an opportunity cost as repositioning benefits will be limited by how far one had extended in duration. Now, at Transform Wealth, we do utilize different types of bonds and structures that do dampen the impact of a change in interest rates. But the takeaway here should be the inherent relationship between changes in interest rates and market values of bonds. Given this current environment, we are now offering access to some alternative strategies to shift some interest rate risk towards other types of risks. Before we get into these alternative strategies, we wanted to spend a few moments on the different types of alternative investment structures and why we have chosen the structures that we have for our clients. Historically, true alternatives were mostly limited to institutional investors or the ultra high net worth. Through private placements and very high accreditation requirements, investors were required to write million-dollar checks for the best alternative managers, or hundreds of thousands for smaller, less-known managers. These remain the most pure exposures in the alternative space, and minimums are not as enormous as they used to be, and that's due to feeder funds with a slightly higher fee. But there are liquidity drawbacks, as these are generally locked up for more than 5 years. They also provide K-1s for annual taxes. Mutual funds are available with some alternative exposure, but along with other restrictions, they are only allowed 15% of the underlying assets to be in illiquid investments. So that is far from a true exposure for the asset classes we are considering. The SEC recognized that it wasn't fair for only the ultra wealthy to access this space and have opened the doors for interval funds to play a role in this space. Interval funds are investment vehicles that are allowed up to 75% in illiquid alternative investments, but must keep approximately 25% in liquid securities to allow for periodic repurchases when investors want to try to exit their position. These have low minimum purchase prices and deliver Form 1099s for tax purposes. So while they're not as pure of an exposure as a private placement, they do provide meaningful exposure while creating the opportunity for periodic liquidity, which is one of the most important nuances to understand when considering interval funds. The intention of an interval fund is to create periods or intervals of liquidity. That said, 75% of the holdings are generally illiquid. In other words, the underlying holdings are not able to be sold on any given day. So if everyone wanted to sell on a given interval, the fund would not be able to accommodate this due to the illiquidity of the underlying holdings. And so, a formulaic way of exiting was created to address this scenario. Every interval fund has different redemption approaches, but here is one of the more common ways it is addressed. A redemption window is set. In this scenario, it is set for once a quarter. Each quarter, the fund will redeem or allow investors to sell up to a total of 5% of the fund's overall assets. In the first scenario here, we see an investor who has invested $100,000 and wants to sell all of their holdings. During that period, the fund as a whole has less than 5% of their overall assets that are requested to be sold, and so this investor will receive 100% of the requested sell amount. In scenario 2, the investor only wants to sell a part of their holdings, but there is a market event that has resulted in significant requests to withdraw from the fund. In this scenario, because the redemption requests are so large, only about 7% of their desired sales are actually occur, and the investor will need to try to sell more again the subsequent quarter. We have chosen this depiction because it is important that investors who invest in these types of investments understand that there are scenarios where those intervals of liquidity may not result in true liquidity. This is both a benefit and a drawback of this type of investment, and all investors in interval strategies must understand that there is an expected benefit of an illiquidity premium, but also the potential for limited liquidity. On this slide, we consider some of the other important factors when considering using alternative investments. We've already discussed liquidity and structure, but here are some other items that I will touch on at a high level and then dive into more deeply within the specific Transform Wealth approved strategies. Fees are generally higher and often have incentive fees. The underlying managers, their strategies, their boundaries, their performance, and their philosophies are critical in the due diligence process for understanding the risks and rewards for their utilization and how they fit within a portfolio. The tax implications and reporting structures are critical for determining fit and asset allocation. Investment minimums and accreditation requirements are also key in determining suitability. These are but some of the factors and spoken to broadly, but we hope they will give you some areas to consider in determining whether or not to add exposures in this space. Now, let's get into the specific income-producing alternative strategies that we see as an opportunity in today's interest rate environment. After analyzing a myriad of alternative investment options, we have distilled our approved strategies for alternative income-producing investments to the Blackstone Real Estate Income Trust and the Scion Ares Diversified Credit Fund. As with all alternative investments and investments in general, there are some suitability requirements that must be considered and should be discussed with your financial advisor. So let's dive into these strategies. Blackstone is one of the world's leading investment managers, focused specifically in the alternative investment markets. The company's real estate platform has more than $200 billion under management and is one of the largest owners, buyers, sellers, and financiers of real estate in the world. With a long track record of success and one of the strongest names in the industry, through thoughtful due diligence, we feel Blackstone is well positioned to continue its success into the future. The Blackstone Real Estate Income Trust, or BREIT for short, is Blackstone's private REIT, which has a perpetual interval structure like we've been discussing. Public REITs are traded on an exchange, and their pricing is driven by supply and demand, similar to that of a stock. A private REIT, on the other hand, does not trade on an exchange, but the value of the REIT is driven by the underlying property values. A real estate investment trust, or REIT, can be thought of as an investment vehicle that owns income-producing real estate. Unit holders own a share of the REIT, and an investment management firm, like Blackstone, provides the asset management decisions for a fee. Blackstone makes the decisions of buying and selling the underlying properties. Tenants of these properties, which are owned by the trust, pay leases and rent and create an income stream to the trust, which is in turn distributed to the unit holders after operating expenses. These underlying properties do have the potential of appreciating or declining in value. There is also a trustee or board that is in place to act on behalf of the unit holders. One other point worth noting is that within a REIT, there are tax considerations, specifically the ability to depreciate the underlying properties, which does have the potential to offset some of the taxes produced by income of these properties. BREIT has a net asset value of $31.6 billion and primarily invests in stabilized income-generating U.S. commercial real estate. The current allocation is 43% in multifamily, 36% in industrial, 12% in net lease, and 9% in other types of properties. Within the portfolio are currently 1,463 different properties, which collectively result in a current 5.21% annual distribution rate to unit holders. Again, there is the opportunity for underlying asset price change, and of course, it is our desire to see these values appreciate, but there is the potential for some depreciation as well. Lastly, this strategy does utilize leverage and is currently utilizing about 35%. While the structure of this is a non-listed REIT, it does follow the interval fund structure. There is a 5% penalty if sold within the first year, but otherwise is available for liquidation on a monthly basis. The fund has capped the total amount that may be sold from the fund to 2% of net asset value per month with a max of 5% per quarter. To date, the fund has met every month's sales requests, but like all interval funds, there is a risk of illiquidity if too many sales are requested at once. There is a current minimum investment of $2,500, and there are some suitability standards as seen here. Additionally, there is some paperwork required for this investment, which we will walk you through if an exposure is desired. As mentioned earlier, alternative investments do have associated management and incentive fees, and we want to walk through those in detail. Remember that buying, selling, operating, and managing real estate does require additional costs. Additionally, alternative investment managers generally align their upside with that of the unit holders through incentive fees, which we will discuss on the next slide. For BREIT, there is an annual management and servicing fee of 1.5%, as well as an incentive fee in which Blackstone shares in an upside above a 5% level. That incentive fee equates to 12.5% of any upside over a 5% annual hurdle rate. Let me describe how that works. For the first 5% of annual return, Blackstone does not receive any of the return, and the investor receives 100% of that return. Once the annual 5% is achieved, Blackstone has a catch-up provision where they will make all of the return until it reaches their 12.5% of overall return. As seen in this slide, that occurs at about 5.7% annual return. Then the sharing will be split at 87.5% to the unit holder and 12.5% to Blackstone. Again, this type of incentive structure is relatively standard for alternative investment strategies. Let's move on to the Scion Ares strategy. Scion has partnered with Ares, one of the world's global leaders in direct lending and private credit. With over $200 billion in assets under management and about 75% of that in the credit markets, Ares is a company with an incredibly strong reputation and access to deal flow. The Scion Ares Diversified Credit Fund is an interval fund strategy that focuses on floating rate, senior secured loans in a well-diversified portfolio across credit strategies. Through consolidation and competition, the number of banks in the market have been on a decline. As a result of banking regulatory constraints and the efficiencies and flexibility in the private markets, private credit has been capturing more and more of the credit markets. In other words, in addition to bank lending, middle market and larger corporations have been turning to the private markets for solutions for their borrowing needs, and Ares is a market leader in this space. This leadership has created the opportunity for Scion to partner with Ares in the creation of the Scion Ares Diversified Credit Fund. With $1.7 billion in assets within this fund, the portfolio managers are able to leverage Ares' tremendous deal flow to build an optimized private credit portfolio for its investors. There are currently 520 borrowers or loans within the portfolio, and shareholders are currently realizing a 5.41% annual distribution rate. More than 93% of the portfolio is in floating rate, which is quite attractive in today's low interest rate environment. This means these holdings are much less sensitive to changes in interest rates, as their yields will rise if interest rates rise, and thus they do not have the same interest rate risks that we've been discussing. The majority of the holdings are in the United States, but the fund does have some diversification in other countries. Additionally, more than 80% of the lending is done through direct or syndicated loans. The additional 17% is in other income-producing securities that we feel are appropriate. This fund does employ some leverage, but that is maxed at 25% and is currently at 18%. This fund also has an interval structure, but is formed in a 40 Act closed-end fund structure. The fund has capped the total amount that may be sold from the fund to 5% of net asset value per quarter, or 20% per year. To date, the fund has met every month's sales requests, but like all interval funds, there is a risk of illiquidity if too many sales are requested at once. There is a current minimum investment of $2,500 and $1,000 for qualified investors. The Scion Aries Fund has an annual 1.25% management fee, and similar to BREIT, does have an incentive fee, though the thresholds and sharing vary slightly. In this case, the incentive fee equates to 15% of any upside over a 6% annual hurdle rate. In other words, for the first 6% of annual return, Scion Aries does not share in the return, and the investor receives 100% of that return. Once the annual 6% or 1.5% quarterly is achieved, Scion Aries has a catch-up provision where they will make all of the return until it reaches their 15% of the overall return. As seen in this slide, that occurs at just over 7% annual return. Then the sharing will be split at 85% to the unit holder and 15% to Scion Aries. Again, this type of incentive structure is relatively standard for alternative investment strategies. Now, it is important to understand that these two investments do have a different risk profile than that of traditional bonds. While they are distributing higher yields, with Blackstone's currently yielding 5.2% and Scion Aries currently yielding 5.4%, they are different assets and will perform differently in different market cycles. Yes, Blackstone does have the potential for additional upside through price appreciation, and does have different interest rate risk characteristics. And yes, Scion Aries does have much less interest rate risk due to the floating rate nature of its loans. But these are less efficient markets than the bond market, and will see volatility that is different than the bond market. Sometimes this volatility is to the upside, and sometimes to the downside. Here, we consider the recent volatility surrounding COVID. As you can see, both strategies were impacted in a much more meaningful way than the US bond market depicted in orange. They have since recovered, and given the current interest rate environment, we do believe moving a portion away from traditional fixed income and towards these alternatives does present an attractive exposure for many of our clients, those who can manage the potential illiquidity from these strategies. For these two strategies, collectively, we are considering a maximum exposure for our clients of 20% of their fixed income exposures. Specific allocations to each will be customized based on each client's needs and exposures to qualified and/or non-qualified accounts, as there are some tax implications to be aware of. There is some paperwork associated with these strategies, but it's just some short forms that we can walk you through. If you would like to learn more about these strategies to determine if they are a good fit, please reach out to us and we can dive into them in greater detail. As mentioned at the beginning, this will be the first of a few presentations that we will be doing within the alternative space, and we understand that these do present added complexity and may require multiple conversations to understand all of the moving pieces. For clarity, we are a fee-only fiduciary and receive no additional benefits should you decide to utilize these strategies. We simply believe this to be a timely opportunity given the current interest rate environment. Take care. Please reach out to us with any questions, and we look forward to speaking with you soon.